In this episode, I'm going to be walking us through the presentation that I delivered at Risk and Profit Conference in Manhattan on August 20th and 21st. It's all about misstructured subsidies in pasture, range, and forage insurance. Also known as PRF, this product is intended to allow ranchers and hay producers to mitigate production risk by holding an insurance policy against the key limiting production factor of forage, rainfall. Some of the details of this product make it so the best options for our farm and ranch may not necessarily be the ones that immediately meet the eye. So let's just go ahead and jump right in. Pasture, range, and forage, PRF. So what is it? It's a rainfall insurance product for grazing or haying lands. The big picture is if it rains less than your coverage level in the time frame that you're covered, you get paid. Your premium is based on the county-based production value of your land in the time frame you insure and your coverage level. And we'll get into all the definitions of how these different terms are used in crafting each policy. Your payment is based on your county's base production value, your coverage level, and the historical average rainfall in your grid. So let's kind of put this in the context of the federal crop insurance program landscape overall. So in traditional crop insurance product, things like yield protection or revenue protection, you insure the output or the product itself. The yield protection, you have a yield guarantee, a threshold of crop production below which you receive compensation. Likewise, with revenue protection, you have a revenue guarantee, the threshold of crop revenue below which you receive compensation. Pretty straightforward. But the point is, what am I insuring? In the yield protection, I'm insuring yield. I'm insuring the production of my crop. The two factors of my income, that is yield and price, are covered in revenue guarantee. It's more difficult to insure pasture, range, or forage because of how production is measured. So I'll just illustrate this with a visual here. So in traditional crop insurance, you are insuring what pays you. We're insuring revenue, which is the product of yield and price. So on the right-hand side, we have our point of sale, the grain elevator or a local co-op that we take our commodity to. We sell it there. Our insurance policy compensates us for any shortfall of our guarantee that we might have at the point of sale. With PRF, you're not insuring forage, you're insuring rainfall. This product assumes that there's a beeline and there's no daylight between your rainfall that you received on your forage and your forage production itself. We are insuring a factor of production that is implied to be the most important in determining production. It is an important limiting factor. Rainfall is immensely important as a limiting factor, but it's not the only limiting factor. And the way that it affects production is not uniform. And I'll get into that a little bit later. We talked about with revenue protection and yield protection, there's basically two sources of an income variation: yield and price. Here, you've got three different levels of it. You've got at the point of sale, you've got price, and then you've got product. Or if we're talking about beef production for the purposes of grazing, you have variation in price and variation in how many pounds per animal you get off of your forage, and also what the quality is, and grading and so forth. And then there's variation of your product based off of production factors. The one we're looking at here is forage, but there's other production factors that go into determining what is the final product going to be that I'm actually taking to the point of sale. And then, of course, there's the factors that influence forage. A big one is rainfall, but there are other factors that influence forage production as well, whether that be disease pressure, heat stress, grazing pressure, all those different things that can go into it. So, thinking about it from that perspective, even if we lumped all the other sources of variation in a particular variable, whether it's at the point of sale, the product itself, or the forage that goes into producing the product, and even if all that's lumped into a single source of variation, there are 8 income variation sources, and PRF ensures only one of them: rainfall. The amount of rainfall that you receive at one time of the year is going to have a different effect on your forage production than the amount of rainfall you get at a different time of the year. And the amount of forage production, the quantity and quality of your forage production, is going to have a nonlinear effect on your final product, i.e., beef production, in different circumstances. If you're putting on a significant amount of biomass in May, for example, that's going to have a different marginal nutritional content on your forage for your cattle than it's going to, say, in August or September. And likewise, if you take that a step backwards again, the amount of rainfall you receive in May is going to have a different effect on your forage production, which is going to have a different effect on your product as it does in August or September. And that's true all across the board, all throughout the year, and all across different locations throughout Kansas. So, with PRF, unlike traditional crop insurance, you're not insuring the product. You're not insuring what pays you. You are insuring a twice removed production factor. So if we look at this diagram, we can kind of get a picture of this. Our point of sale, that's where our income comes from. We get paid for our product. Now there's variation because of price that happens at the point of sale, but we get paid for our product. But we're not insuring our product. We're not even insuring our forage. It's called a forage policy, but we're actually insuring rainfall. That's what our insurance policy is actually compensating us for. So we're all the way over here on the left side of the screen, whereas our source of income is all the way to the right. So the factor that PRF ensures, rainfall, is measured as an index based on the historical index within a 2-month time period. So, for example, just to explain that, if the 2-month time period of May and June historically averages 10 inches of rainfall total, then in that period, the historical index is 10 inches equals 100%. So your average gets set to 100%. And then from there is when the actual value for a given year can flex based off of what rainfall you receive. So if that period in a certain year gets 8 inches of rain, then the actual index value for that year would be 8 inches divided by 10 inches, or 80%. Simple enough. The historical index for each period is based on the geographic grid, not by county. And it doesn't even follow any political boundaries. So these grids are 0.25 degrees latitude by 0.25 degrees longitude. So at each of the levels of Kansas latitudes that we're at, we're kind of in the mid latitudes on the globe. These are 17.3 miles north to south. So that would be the height, for lack of a better term. And between 13.3 at the northern border and 13.8 miles west to east at the southern border. So because latitude and longitude, they're not uniform distance at every latitude and longitude. That's why there's a little bit of variation. But overall, these grids are about 230 square miles, or about a quarter to a third the size of a Kansas county. So those are the areas that are being used to measure rainfall. So if your property falls within a particular grid, that is the grid that is being used to calculate whether or not your property will receive a payment. So when you're purchasing a PRF policy, what do you actually decide? Well, you choose the intervals, the coverage level, and the productivity factor. So what are the intervals? So your coverage is for these 2-month intervals. For example, January, February is one interval, February, March is one interval, so on and so forth. Now, the intervals that you select can't overlap, so you can't choose both the January, February interval and the February, March. That has an overlapping month of February, but you could choose a January, February interval and a March, April interval. You can distribute your coverage across 2 to 6 intervals. So you could have it as simple as I'm putting 50% on January, February, and 50% on March, April. Or you could have it be as complex as I'm distributing all my coverage across all 6 non overlapping intervals. And no interval can have more than 60% of the coverage share. So if you were going to divvy up across 2, you couldn't put 90% on one and 10% on the other. You'd have to do 60-40 at most. But you can have up to 6. The coverage levels that you can choose range from 70% to 90%. Now, this product is subsidized. It's going to be a key component of my later discussion. The subsidy level that you receive varies based off of your coverage level. So if you have a policy that has at the 70% coverage rate, your premiums are subsidized at 59%. So if your premium was $10 an acre and you had a 70% policy, then you would only pay $4.10 per acre because $5.90 would be covered by subsidy. And so on and so forth. Once you get up to 90%, it's down to 51%. The productivity factor is a weight that you select based on how well you think your land performs relative to average in your county. For example, if you have a parcel of land that you are insuring that you think really outperforms a lot of the surrounding land, then you can increase your productivity factor up to 150% of the county average, and that will increase both your premiums and your indemnities. If you think your property does worse than the land around it, then you can actually bring the productivity factor down as low as 61%, and that will also correspondingly adjust your premiums and indemnities. So, how is payment calculated? Payment is based on your county base value and what's called a payment calculation factor, or PCF. The county base value estimates your average value of production of grazing or haying lands in your county. So, here's a couple of examples. Far northeast, where there's a lot more rainfall, Donovan County, $52.30 per acre is what's listed currently as the county base value. Go to the far southwest of the state, Morton County, their average is 27 an acre. So basically almost completely half. And like I said, adjusting that productivity factor can raise that or lower that accordingly based on how you perceive the quality of production on your land. So your dollar amount of protection is your county base value times your coverage level. So in the case of Donovan County, $52.30 an acre times a 70% coverage level. How much are you protected per acre? That's 3661. That 3661 is equivalent to your guarantee in other insurance products. Your payment calculation factor is your payment per dollar amount of protection using this formula. So PCF equals your coverage level minus your actual index value divided by your coverage level. So remember that actual index value is how far off of that 100% average is my actual rainfall for the interval that I'm insured for. For your final payment, you want to multiply your PCF by the covered interval share. That is, how much of your policy is allocated to each of those intervals you're insuring. Add them together and multiply that by your guarantee, your dollar amount of protection, and however many acres are insured. So here's kind of an example of payment calculation factors over the course. This is for a single grid. So if we look at from left to right, we see all of our coverage intervals. They're not labeled here, but they're for purposes of illustration. January, February on the left, all the way to November, December on the right. And then the years of the actual index values going from recent in time down lower. And there's data on this going back all the way to 1948. So the most recent complete year that we have on file is 2025. That's that top row. But basically, you kind of get an idea that there are plenty of intervals, there are plenty of years where there was no payment calculation factor above zero. And what that means is your actual index value in that interval in that year did not fall below the coverage level, so you didn't receive a payment. That's all that that's saying. But of course, there are some years and some intervals where there are indemnities, and those are the ones with positive values. So now we'll get into how premiums are designed. So premium rates vary by interval and by grid. It's more expensive to insure drier months than wetter months. And we'll go into why that is. So let's take an example, grid number 20224 in Barton County. At 70% coverage level, the November-December rate is 23.29 cents per dollar guaranteed. In June-July, that interval, the wettest interval of the year, it's only 8.58 cents per dollar of guarantee. So you can see that's almost a tripling of the premium rate in the drier months of the year than in the wetter months of the year. Interesting to think about. It's also more expensive to insure drier grids than wetter grids. So, same kind of logic as before. If we look at grid number 20516 in Seward County, way southwest Kansas, where it's very dry, 70% coverage level again, their driest interval rate costs 29.96, almost 30 cents per dollar of protection. All the way in the southeast, the wettest part of the state, grid number 20840 in Cherokee County at 70% coverage level, their driest interval rate is 14.55 cents per dollar of protection. So basically, the wettest part of the state during its driest interval is half the price of the driest interval in the driest part of the state, just to illustrate how those premium rates vary. So the premium formula looks like this. It's the premium rate, so that would be these cents per dollars of protection, times how much of your policy is put to that interval. That's that share percent. So if I say, well, 40% of my policy in Barton County is going to June, July, then I multiply 40% times that 8.58 cents. So that's how that's calculated. So you take all of those and you add them together based off of how much the percentage is and what the premium rate is. That's what that sigma, that summation symbol is showing. Then you take that and you multiply it by your guarantee. That's that base value times your coverage level. And then, of course, multiplying by acres. And then, of course, like we mentioned before, the subsidy rate. So once you multiply that together, that's going to be your premium payment. Premium subsidies are structured to produce adverse selection. And I will explain what that means very shortly. First, we're going to walk through an example. Here's a map of Kansas counties. Let's pick Cloud County, close to home for us. Now, this is an image from the PRF rainfall website where you can locate grids that are used to calculate actual index values. So here you can see Concordia near the middle of the screen. This is in Cloud County. If we look just to the north side, we see grid number 23530. Okay, so we've got plenty of ranchers in our area that have land within that grid. So we're going to use it as our example. The Cloud County county-based value is $49.30. Let's say that we choose coverage level of 85%. If we choose 85% coverage level, then our premium subsidy is going to be 55%. Let's say that we choose 3 intervals to allocate our policy to. Let's say we choose the period of February-March. We put 30% of our policy on that, 40% on the May-June interval, and 30% on our September and October interval, for a total of 100%. The February-March interval is the most expensive, as it's the driest interval we've chosen, 16.11 cents per dollar of protection. Our May-June interval is our cheapest, as it's our wettest interval we've chosen, 5.34 cents per dollar of protection. And September-October, between them, 10.61 cents per dollar of protection. Now, here we do the math and add it all together. So we take our county base value, 49.3, times our coverage level, 0.85, and that gets us our guarantee. Then we multiply it by our subsidy rate. So that's the 1 minus 0.55. That shows us how much of that premium are we going to be responsible for. So it's 100% minus 55%, which would be 45%. And then that's when we get into multiplying the percent allocation of our policy to each of our intervals. So we put 30% on February, March. So we multiply zero point 0.3 times 0.1611. Then we take 40%, zero point 0.4 times 5.34 cents, or 0.0534, and do the same with September, October. 30%, that 0.3, times 10.61 cents, that 0.1061, and we multiply and add that all together and we get 1.91. So that means that our premium that we are responsible for this policy is $1.91 per acre. Now we'll calculate the indemnity side. So this is using 2025 actual indices. In February, March, our actual index value, that is, what percent of that 100% average did we get in rainfall in February, March? 62.5%. In May, June, we got 98.4% of what we average historically for May, June. And then September, October, we received 48.1% of what we historically average for September, October. So in every single interval, we average below historical average for that interval. Now we do our payment calculation factor. And in other words, that's the coverage level weighted rain shortfall. So take a look at February, March. Our coverage level was 85%. We subtract 62.5% and divide that by the coverage level to get 26.47 cents per dollar of protection. In May, June, we get a negative value because 98.4 is above our 85% coverage rate. So if it's a negative payment calculation factor, then we don't get anything because we did not have a shortfall that warranted a payment because our index value did not fall below the coverage level. In September, October, we had 48.1% of our historical average rainfall for that period. So that's a major shortfall, and that comes out to 43.41 cents per dollar of protection. So if we do the same thing, we multiply our guarantee by the indemnities we receive for each of the periods that were covered. So 30% times that 2647, 40% times 0 for May, June, and 30% times 4341 for September, October. Our indemnity comes out to an $8.78 an acre. So our net indemnity, if we take our indemnity minus our premium, we're actually getting $6.87 per acre. And if we've insured 1,000 acres, that's almost $7,000. So that's just an example of how this insurance policy works. I'll just cut to the chase and let the cat out of the bag early. That example was just one grid in one county in 1 year. In the state of Kansas, there are over 350 grids, 105 counties, and 77 years of available actual rainfall data. There is a general strategy for choosing policy parameters that maximizes value of net indemnity and maximizes frequency of a positive net indemnity. What I'm saying is, no matter where you are in the state, there is a strategy that you can employ to make sure that not only over the long term can you make sure that you're making the most money off of this insurance product, but also that you can make money off of it more often than any other strategy. And that is choose the highest coverage level, choose the highest productivity factor, and choose the driest intervals. If you choose 90% coverage level, 150% productivity factor, and place all of your coverage on the January, February, and November, December coverage intervals, that is going to, both in the long term and most often, give you the highest level of net indemnity.